I'm here with Yang Lee, Head of Asian Equities from Barings Asset Management. Mr. Lee, can you tell us how did the crash in the Chinese stock market last month happen?
I think the story of the volatility in the Chinese stock market, especially the onshore Chinese stock market, it's the so-called A-share market, is really a bit a volatile story of the policy direction of the Chinese government in a way. The Chinese government was trying to encourage equity investment for its citizens in a way to shift out liquidity from the property market, which they felt was being a little bit overheated. In doing that, funneled a lot of liquidity into the stock market, and that created a bit of a very strong market, as you saw earlier in this year. In fact, the China A-share market is still significant on a one-year view, significantly higher than it was 1 year ago. But in that process, the Chinese government became a bit concerned that perhaps the equity market itself, as well, in turn, was becoming overheated. So they introduced some market cooling measures, which likewise worked very well. And that sort of triggered off a lot of margin selling as investors were leveraged into the stock market. And that meant that there was a high downward volatility of the stock markets as they came. And so that has really created the volatility that you've seen in the onshore market in recent months. Also, in the background of that is that the Chinese economy itself is slowing down. As you know, Chinese economy used to grow, almost 10% a year, but clearly that, given the size of the Chinese economy now, that cannot continue forever, nor should it continue for that pace, because that simply creates too much stresses on the Chinese economy and on the Chinese society. So I think the markets were overall a little bit concerned in the background on a slowing Chinese economy, and coupled with some liquidity concerns, that's created the volatility in the Asian market.
And where do you see the Shanghai Composite Index in the short term by the end of the year? You mentioned the volatility. Does it continue like that?
Mm-hmm. Well, I think we don't want to really give a strong sort of forecast of where we think an index will be at the end of the year. We're much more focused on the long-term growth of individual companies and stocks. In the long term, I think we are very confident that the Chinese economy will continue to grow, albeit at a slower pace, and that certain companies that we choose and that we like will grow at a faster pace than that, and therefore will be a beneficiary of the gradual and long-term growth of the Chinese economy as well as the Chinese stock market.
But you believe the 7% growth that the Chinese government mentions is it true? Is true, or is it not true?
There is some, let's say, skepticism on whether the Chinese economy really is growing at 7%. Again, from our perspective, it's not so important for us that if it's really 7% or 7.1 or 6.9 or whatnot. From our perspective, we're looking for specific companies and specific stocks that will do well within the Chinese economy. So really no strong view as to that.
But how did the problems in China affect the other markets in Asia?
I think it's important to remember the background of this, that you've had a lot of volatility not only in China, but globally, especially in emerging markets. Earlier this year, you had the sort of the turbulence surrounding Greece, and then even more recently, you've had Brazil being downgraded by the credit rating agencies. So the world was a sort of somewhat volatile place to begin with. You had this volatility in the Chinese stock market, as well as concerns over, let's say, the impending rate hike by the U.S. Fed. And so that all, I think, sort of combined to produce some of the uncertainty that have created the volatility, not only in Asian and in emerging markets, but even in Europe and the U.S. stock markets as well.
Where do you see investment opportunities across the Asian region right now?
I think we're seeing them, almost across in many markets and many economies. Again, we are more specifically focused on companies rather than in one economy or one market. What we like to focus on is companies that benefit from specific areas of growth that we know will be sustainable in the long term. So, of course, we like names that benefit from the long-term consumption growth in Asia. So, as you know, income levels are rising steadily in most Asian countries, in most Asian economies. And so, as the income levels up, people have more money to spend on clothing, on healthcare, on cosmetics, stuff like that. And so, certain key companies in the region benefit from that. And we're really focused on them most of all. Having said that, of course, the most of the growth of that kind of consumption growth will happen in, let's say, less developed economies in Southeast Asia or India, economies like that. Economies such as Korea, Taiwan, Singapore, Hong Kong, these are all basically developed economies. So there isn't that much more consumption growth in those type of economies as well. But even in those type of countries, we find good names that benefit from consumption growth.
Can you mention some single companies that you invested in right now or that you believe in that are going to have a good future?
Well, yeah, I can tell you names that we're positive on right now, and of course this can change over time. But one area that we like is in the internet space and the increasing onlineification, if you want to say that way, of Asia and especially China. So one name that we do like is a Chinese company called Tencent. This company it still is the largest PC gaming company in China. And it derives a lot of revenue, as you might expect, from its very successful gaming business. In fact, it's the owner of one of the game called League of Legends, which is globally one of the most popular online games right now. But it uses its gaming revenue to invest into other areas of internet, which are perhaps faster growing right now. Things like social networks such as WeChat, which is essentially the WhatsApp of China, and other areas increasingly like content. And what we mean by content is that increasingly the young people of China, or young people globally, they are increasingly use the internet or their mobile device, their smartphone or tablet, as a way to view content. What I mean by content is video, movies, TV shows, music, what have you. So Tencent is really, I think, has a head start in that area. For example, Tencent has a contract with the U.S. NBA, the basketball, and so if you're Chinese, the way you watch NBA games is through your smartphone, through Tencent. It also is producing original content, as well as importing movies and such as that to really take advantage of the online infrastructure in China. So we think we're still very positive on the growth outlook of that company.
Are there any regions in Asia that you avoid right now?
No, I think it's not a case that we're specifically avoiding any specific market or country. I think it's more of a case of where we are finding the type of companies, the type of growth stories that we like, that we want to invest in, and so that in that respect, we like, as I mentioned, South Asia, including India, markets like Indonesia, which have very strong long-term growth profiles. Perhaps again, we're not making any sort of judgment on the markets themselves, simply looking at the kind of stocks, the growth stories that we like.
The US Fed is going to increase the funds rate soon. How will this affect the Asian markets? What do you think?
Well, historically, higher interest rates in the developed markets has not been good for emerging markets. It creates a bit of stress on the currencies and on the funding situation, especially if you're considered a so-called sort of vulnerable economy or market. What we mean by vulnerable is those economies that have current account deficits or fiscal deficits, things like that. So normally markets such as India or Indonesia would be considered somewhat vulnerable to a higher rate interest rate environment, which causes increased volatility. And indeed, that is one reason that you've seen the increased volatility of markets in recent months, because the market was pricing in what will happen after if and when the U.S. Fed raises the rates. And that has also been accompanied by a strong U.S. dollar, as you've seen. So almost all currencies, including the euro, has weakened against the U.S. dollar. And indeed, Asian currencies have weakened as well. Although it's very hard to say exactly what will happen, I'm thinking that most of that volatility has already sort of been reflected in the currencies, the US dollar, as well as the stock markets. So unless there is a real sort of new factor that the markets have not really considered, we think that the rate hike, when it does happen, will go smoothly.
Mr. Lee, thank you very much.
Thank you very much.